and hopefully in a second, everyone can see my screen. Is that right? Someone give me a thumbs up. Okay, perfect. Well, I didn't introduce myself before because I figured I'd go last since I'm going to be presenting, but I am Asaf Bernstein with the University of Colorado Boulder. This is joint work with Peter at Stanford, who unfortunately can't make it, but I've got the Slack channel open, so I'll try to sort of track as people go along. Obviously, Tony, thank you so much for putting together the conference, and thank you all for being here. If you've looked in the Slack, you know this is very early work with Peter, so any feedback you guys can offer is going to be super valuable. As Tony said, let me apologize in advance. You might hear dogs barking. You might hear babies crying. I also changed my daughter just a little bit before, and so I'm like 50-50 that there's poop somewhere on myself. So if you see that, my apologies. Okay. All right, so let's get into the paper itself. So what is our research question? We were looking at the effect of mortgage amortization on wealth accumulation. As far as I know, we're the first paper to look at that, so I'll try to very carefully explain what our research question actually means and why we think this is an elasticity worth looking at. So without loss of generality, we can think of wealth accumulation as made up of the amount of mortgage debt you repay, which we're going to call amortization, plus everything else. And we're going to call that net non-mortgage savings. So that can be stuff in your checking account, that can be other liabilities, et cetera. Okay? Now, we're going to say that things are fungible if the following is true, right? These are both sources of wealth for the household. So if I make you repay your debt by $1 in a given year, and what you do is you pay for that by reducing the amount in your checking account by $1. In other words, you just transfer money from your checking account into your liabilities, increasing your home equity, but reducing the amount in your checking account. We're going to say you're acting as if these are perfect substitutes. They're basically fungible sources of wealth. Okay? And so the net result is going to be no change in wealth accumulation. Yes, you have more home equity, but now you have less in your checking account. Okay? So that's going to mean that what we call our wealth elasticity, which is the change in wealth for the change in that amortization, for the change in that mortgage debt repayment, would be 0 in this case. And that's going to be our null hypothesis, which is that moving around the amount of mortgage debt you're going to have to pay in a year isn't moving around your wealth accumulation. Okay, but what's another plausible story? Well, I'm still going to increase your mortgage debt repayment by, let's say, $1 in a year, but wealth accumulation is a function of your income and expenses in a given year. So let's say instead of changing your checking account, you reduce expenses by $1. You reduce your consumption, let's say, by $1. Make no change in your checking account. In that case, there would be no fungibility. You're not treating these sources of wealth accounts as if they were similar. So when I reduce amortization, when I increase your amortization, you do nothing to your net non-mortgage savings. And so subsequently, there's going to be increase your wealth of $1, right? Because you've cut expenses. And so that's going to give you a pretty extreme example, which is a wealth elasticity of 1. Every $1 of debt I make you repay, you wealth accumulate. And so this research question that we're going to ask is the wealth elasticity different from 0? And if it is, what's our best estimate of what that elasticity means? Now, before I sort of dive into things, let me be clear, because I think this can get a little confusing. Mortgage payment in a given month is going to be made up of the mortgage debt repayment, which is what we're talking about, the amortization, and things like interest expenses, fees, things like that. There's a lot of papers that have looked at changes in interest rates, right? So DiMaggio et al. Is sort of the most famous of that example, right? But in that setting, what you're actually moving around is you're moving around actual expenses that are going out to the lender. So this is money being pulled out of your pocket, whereas what we're doing in this paper is we're not pulling money out of all your pockets, we're just moving it from your back pocket, say, to your front pocket, just from different wealth accounts, okay? So why do we care? Because if households don't treat these things as fungible, so as microeconomists, we care that it's the case that they don't treat their back pocket the same as their front pocket. They don't treat home equity the same as they do something in their checking account. And that has implications for macroprudential policy as well, both ex ante and ex post, right? So in particular, in this paper itself, we're going to look at a regulation trying to improve financial stability by getting people to amortize and build up home equity. But if people offset that by reducing their amount of liquid savings perfectly, then there's going to be no change in their wealth accumulation. All that's going to happen is they're going to shift funds from a liquid account to an illiquid account. And in many respects, we probably think those people are less stable, not more stable. Right? And that's going to be true about ex ante policies, but also ex post as well, which is after the fact, if we have counter-cyclical mortgage designs that switch from interest only to amortization, like they have in Campbell et al., then if households just undo the amount they were saving in liquid assets in response to that, that's not going to have the intended effect. Okay? The other place that's going to be really important is public economics discussions on the effects of home ownership on wealth accumulation. Because amortizing mortgages is the most common way that households actually finance home ownership. So to the extent that mortgage amortization leads to large changes in wealth accumulation, that has a super important implication for people's long-term wealth accumulation and how we think about retirement policies and the role that mortgage design plays within those retirement policies. Okay. So given that, what are the challenges we're going to face as empiricists in this setting? So one is debt repayment and savings are obviously going to be co-determined, both within a household, but also generally speaking, the households who choose to have interest-only mortgages are just going to be very different from the households who choose not to, and a lot of papers have shown that. So we want some sort of exogenous shifter in debt repayment or amortization, and then you want some sort of detailed information on household wealth so you can see the outcomes of those effects, okay? Which is why we're going to look at a natural quote-unquote experiment from a Dutch macroprudential policy aimed at financial stability. So prior to the regulation, about 3/4 of new mortgages were partially interest only, which meant they weren't fully amortizing over the length of the mortgage, usually about 50% less. After the regulation, okay, they're going to remove the tax benefits and conformability of those mortgages for first-time home buyers. And so there's a massive decline in that sort of origination for interest-only mortgages, leading to a large change in debt repayment, okay? We're then going to use administrative data, which is going to have detailed records on assets, income, and liabilities for the entire population who live in the Netherlands from 2007 to 2016, which is going to let us implement a design where we can look at wealth accumulation, say in 2015, so over the same period, for first-time home buyers who buy before versus after the regulation. And we can look at all first-time home buyers in the entire country. So what do we find? So the first thing we find, surprisingly, is a wealth elasticity of around 1. So basically every dollar of increased debt they have to repay via the amortization leads to $1 increase in wealth accumulation. In other words, we see very little change in their non-mortgage savings, such as financial assets. It also doesn't look like that elasticity is being biased by selection effects. We see no evidence of bunching. And the other thing we can do is we can use variation in the timing of home purchase based off a life event, like having a child. So we can say, here's a subgroup of people who have a child between 2012 and 2013 that's going to move around when they buy their house, plausibly for a reason unrelated to the regulation, one would imagine, and we're going to get an elasticity that's very similar, okay? The other thing we find is that it's not just coming from households who don't save. My guess is a number of you were already thinking like, well, Asaf, you sort of baked this in. We just forced a bunch of people to save, and if they don't save at all, now they save more. But honestly, most of the households in our setting have enough liquid assets that they can make up for the mortgage amortization just by reducing those accounts. And so what we can also do is focus on households who have tons of liquid assets, and we see for that group, we have a very similar elasticity. So given that, what kind of mechanism do we think could plausibly explain such a large elasticity? You're going to have to talk about mechanisms where households maybe have large liquidity wedges, right? Home equity is very different from what I have in my checking account, and have huge precautionary savings motives. Or models where mortgage maybe is a commitment device, or other behavioral models maybe where households think about mortgage repayments the same as they do interest rates. So they sort of conflate bills and debt repayment. Okay. This increased wealth accumulation doesn't come from nowhere, right? Presumably somehow they have to sort of quote unquote finance, pay for this increase. And what we see is that there's an increase in income and a reduction in consumption is sort of the residual, which seems to explain the increase in wealth accumulation for this subgroup, okay? And this suggests very important implications for the effect of mortgage design on home ownership. Okay. So let's talk very briefly about the Dutch mortgage environment that we're going to be looking at. This is incredibly harsh recourse. So think more harsh recourse than student loans in the US, okay? That's going to support very high loan to originations. So you're going to see in our sample, and this is true overall, most people, when they buy their home, have origination loan to values greater than 100%, where that amount greater than 100% pays for the tax associated with buying a house, moving costs, any refurbishing, et cetera, et cetera. Okay, so there's going to be very few limits on the size of a household, size of house a household can buy from the LTV constraints. What's really going to constrain them is going to be debt to income requirements. Okay, and so households can sort of buy up to the point at which they sort of cap up against that debt to income requirement. And we do see a decent number of households basically hitting up to that regulatory limit. Okay. As I said before, in terms of this environment for amortization, we're going to have partial amortization, which means before the regulation, it's going to be about 50% amortizing. And then afterwards, they're going to be fully amortizing. Okay. One extra detail is we have interest-only mortgages, which are the ones we talked about with no amortization. We're going to have annuities, which are going to be standard amortizing contracts like you have in the US. The Dutch also have this weird thing called linked savings account. So in the linked savings account, it's sort of a clever thing. You put money into an account, which is just an escrow with the bank. The bank doesn't actually write down your liability, which means you still make the full interest payment. You get the full interest deductibility, and then they just pay you the money themselves in a tax deductible way. But the money that's in that account can only be used to repay the mortgage. So we treat those linked savings accounts, the amount in those accounts, as if they were negative mortgage debt, because basically that's what they can be used to pay. Okay? In terms of refinancing in this environment, unlike in, say, the US, you're going to lose the deduction if you cash out refi for non-housing consumption. And there's going to be additional fees if you move, except for in times when, there's going to be additional fees if you try to cash out refi unless you move or there's an interest rate reset, okay? But a number of households still kind of use resets and things like that as a period to basically refinance prior to maturity, kick the can down the road so they don't have to pay these sort of large bullet payments at the end, okay? So what's the regulation itself? I'm sorry, I know people are also replying in the Slack, but I am having trouble multitasking. So I will probably just go through at the end and we can loop back. And Anthony can do his best to sort of collate some of the points and we'll sort of call on people at the end. In terms of the regulation, this financial stability program was announced in 2012, starting for purchase contracts January 1st of 2013. After that, only 30-year amortizing mortgages were eligible for the mortgage interest deduction and were considered conforming. And this applied only to first-time home buyers with existing homeowners grandfathered in under the existing regulations, okay, with the goal of improving home equity and hopefully financial stability. Prior to the regulation, as I said, most mortgages were partially interest only with a 50% cap, and most households had mortgages of that type, which is nice for external validity purposes, right? We're not treating, if we came in the US and just banned interest-only mortgages, we'd be looking at a very weird subgroup of people who took out interest-only mortgages and the effect on that group. But in this case, it's like the vast majority of people in the sample, and so that gives us some nice validity. Okay. The other thing that's sort of critical in this setting, I sort of mentioned this before, but it's worth emphasizing, is this is not going to affect debt to income limits. Okay, this seems counterintuitive, right? Because I'm now going to make you amortize your mortgage. Okay, but what happens is the Dutch were actually pretending as if they were 30-year amortizing loans even before this came into place. So there's going to be no regulatory effect on debt to income limits associated with this regulation, which is kind of nice and maybe part of the reason we don't see much of a selection effect. Okay. So what is our sample? Our sample is going to be sort of all first-time home buyers in the Netherlands over this period. These are going to be relatively wealthy because they're buying a house. They're relatively young, again, because they're buying a house, but we will have some older households, which is going to be useful for us. They're going to be very highly levered. As I said before, if you look at their loan to value, even at the end of 2014, which includes some amortization, the median loan to value is 105%. The 25th percentile is 101%. Okay, so this is what I meant when I say they have a very high loan to value, and they're not that much, there really isn't much of a constraint coming from the LTV side. They also have a lot of liquid financial savings, right? So in 2014, the median household has 8,000 in liquid financial savings, which is going to be way more than they would need to sort of make the amortizing mortgage payments that we're talking about. So most people aren't going to be literally non-savers who are unable, in theory, to substitute out of their liquid savings, stock of liquid savings, not to mention their flow as well. Okay. So very important for us, since we're going to talk about the effect on wealth and use this great data, is what we're actually defining wealth to be and what it includes. Okay, so our change in wealth, which is going to be our wealth accumulation, is going to be change in assets minus change in liabilities. And I'm not sort of including in here like your human capital, things like that. Okay, and so our assets, so these are all going to be things we can actually measure in the Dutch data set, right? So we're going to see how much you have in the bank, so deposits, checking, and savings accounts. We're going to see how much you have in secondary market securities, stocks, bonds, et cetera, and your voluntary pension contributions. On the liability side, we're going to see your mortgages, how much mortgage debt you repay. And we're going to see other liabilities coming from the credit registry, where the mortgages are a function of what we can see from tax records, plus basically a subset where we match, we can sort of figure out how to deal with these sort of linked savings account. And we're going to count, again, those linked savings account. If you put $100 into your linked savings account, that's as if your mortgage was $100 less. Okay. So what are we going to do? We're going to compare, say, the amount of mortgage repayment for a given household I from January to December 2015. Cohort by cohort based on when they closed on their house, okay? And that's what that C is going to be, okay? The change in wealth is going to be over the same period. And so what's going to be nice is we're going to be comparing different cohorts, but their behavior over the same time period. And so we're not going to have sort of macroeconomic effects happening simultaneously, okay? Now, one other critical detail is we see when people actually close on the property, when they transfer into those properties, but the actual regulation is based on when you go under contract. And so it's usually at least 2 months from when you go under contract to when you actually close. So what's going to happen is really only properties after March 1st, 2013 are going to start to be treated. And that's going to increase. and really stopping around May, okay, at which point basically everyone's going to be treated after that point. All right, so what does that look like? Let's look at some actual graphs. So what I have here is a lot going on, but I'll try to explain. So the y-axis, I would say the x-axis here has the cohort. So this is the month when you actually closed on your property, right? The red line indicates after which you're going to start to see people treated by the regulation. I also on that x-axis have the age, which is months since purchase, relative to the beginning of 2015. Why the beginning of 2015? Because we're going to look at your mortgage amortization over 2015. Okay, so over the same time period for each of these groups. Okay, where we're comparing first-time home buyers who bought between 2012 and 2013. Okay, so for right around the regulation, this is going to be about 2 years afterwards for the beginning of 2015, about 3 years for after. So 2 to 3 is going to be the time period. We've got what we're looking at here is the amount of mortgage amortization over that period. You can see it's relatively smooth and flat. Then for after the regulation, it starts to rise, and then it's permanently higher after that point by about €2,000 per year. Okay, so that's the amount of additional mortgage debt that we're paying each year. There's a secondary y-axis, just to avoid any confusion. All we've done is literally divide the first y-axis by the national, the population-wide mean household gross income, just to give you an idea of the magnitudes here. And so this is something like 3% of household gross income, or about 5% of household after-tax income, which is not a negligible amount of additional repayment of debt. Okay, so what would this look like as a response of non-mortgage savings in a hypothetical world if these things were perfectly fungible? Okay, so this is make-believe data. Okay, so in make-believe data world, here in the yellow line, we have net non-mortgage savings. It would perfectly offset the mortgage debt repayment. And so if we looked at wealth, which is here in gray, and it's probably hard to see because it's perfectly flat. Basically, these things would fully offset. Now, what do we actually see? If we look at changes in liquid assets over that period, we actually see that the change in liquid assets is flat. In other words, they're not offsetting the increased debt repayment by altering the amount of liquid savings that they have, either by paying down their stock or by reducing their flow. Okay? And we can do this for full financial assets, including voluntary pension contributions, and again, completely flat. We can look at non-mortgage liabilities, another part of that sort of net non-mortgage savings. Again, completely flat for this group. So in aggregate, what do we see when we combine all that sort of net non-house wealth? Well, we're going to see it's basically flat across the cutoff. So what does that imply? That implies a fungibility of 0. And this gray line says, well, what's the effect on wealth accumulation over that time period? Well, it's going to basically move 1 for 1 with the increase in mortgage debt repayment. So when I talk about a wealth elasticity close to 1, this is the picture. This is what I mean. Okay. Now, it's smooth as you go across an age and then jumps, and then it's smooth again. So it really doesn't seem likely that sort of we're confounded by age effects or any of those sorts of pieces. Okay. And we can do it across multiple years and see a very similar effect. You might still be concerned that people are sort of selecting to one side or the other. So one of the things we do here in brown, the brown line is the number of home purchases for our sample of first-time home buyers around the regulation, right? If you were really worried, you would expect to see some sort of bunching here near the red line as households try to avoid the regulation, right? But we basically don't see any evidence of that. Okay? What you do see is bunching earlier in the year for a June 2012 transaction tax increase. So it's not like households never bunch in our sample of first-time home buyers, but they don't seem to do it in response to this regulation, which at least gives us some comfort that it doesn't look like there's at least large-scale selection effects for who's entering as first-time home buyers. Okay. The other thing I don't show here, and I don't have it in the paper yet too, so this is what happens when you have an early paper, right, is that it looks like based on pre-regulation characteristics, they look pretty similar. So there's sort of a smoothness in pre-regulation income, pre-regulation wealth accumulation, pre-regulation birth year, aka age, the number of members of the household, the house value that they actually purchase isn't any higher and is basically smooth across the cutoff. And we're right now working to get the LTVs figured out at origination, okay? And we think part of the reason, again, is that households are in large part buying up to their debt to income regulatory limit, and that hasn't changed, right? And so in at least in some respects, we think that households aren't being pushed in terms of their house price by that, okay? That being said, there could be some sort of unobservables we don't see that are moving around who buys when, and then it happens to be correlated with the amount of mortgage amortization, mortgage debt they want to pay. It's a little weird because they don't really want to appear to sort of correlate on other things, and they don't want to pay down sort of non-housing, they don't want to build up non-housing wealth. So it's a little odd, but it's still possible. So one of the things we do is we focus on the subset who have a life event. Again, this is a change in the number of members in a household in a given month. So this is things like the birth of a child, okay? And so that's going to drive, for many households, the timing of their purchase decision. And so we're going to take the quarter, not when you buy your house, but the quarter when you had that life event, and use that as our source of variation in this x-axis, okay? And so these are the cohorts for your life event quarter for when you had your life event. And we're plotting the same thing we had before, where we've got wealth in gray, in black we have mortgage amortization. And what you see is that prior to this, changes in that timing of life event have very little effect on your wealth accumulation. But afterwards, we see that it actually increases the probability you're going to buy after, if you have a life event after 2013, in the 2013 period. And it increases the amount of mortgage amortization, how much mortgage debt you're going to repay because you've been pushed into that new mortgage regulatory environment. And you're going to be matched, basically, as we can see again, with a near one-for-one change in our wealth accumulation. Okay. All right, so when we run the sort of formal IV, what is that going to look like? Well, now we're just going to do a two-stage least squares, exact same design, okay, but treated are just going to be those after March 1st, 2013. And we're usually going to pick a window a little closer for the cutoff, so it's largely irrelevant. And then we can throw in other controls, which we sometimes will and sometimes won't do. It doesn't matter too much for the region you're in and or sort of pre-regulatory characteristics of the household, okay? So in this first table, the way I've sort of set this up is 1 to 3 there means columns 1 to 3 is what I'm referring to. The next one is 4 is column 4, 5 is column 5, just to make this go as quickly as possible. So columns 1 through 3, just so that mortgage repayment and wealth is sort of what we saw in the figure, about a €2,000 increase in 2015. And in column 3, you can see that equates to almost exactly an elasticity of 1 and a relatively well-defined elasticity with the low end of the estimate. They're still at 0.92, which suggests a massive effect of mortgage repayment and amortization on wealth accumulation, okay? In column 4, we showed the reverse side of this, which is like basically no fungibility. So there's basically no observable change in non-housing wealth in 2015 in response to being purchasing after the regulation. And in column 5, we just do the analysis we did in the figure of life event buyers, where the source of variation is having a life event after the regulation, re-estimate that elasticity. And you can see in the confidence intervals, this thing captures 1, and it's sort of similar to the estimate we have in column 3. Okay? I sort of not shown here, but you can include a bunch of various covariates and controls. It doesn't matter. We can take people who only buy in 2013, okay, January and February versus March and April, and you're going to get a very similar elasticity, okay? That's all sort of comforting that it looks like it's being driven with sort of the treatment of interest, okay? Here we can sort of look at these life event buyers. In columns 1 to 3, I just show you that buying after, based on your, having a life event after the regulation isn't statistically correlated with household income, financial assets accumulation, or wealth accumulation prior to the regulation. And I can tell you that these numbers are sometimes big, sometimes small, but they're almost never statistically significant across a bunch of different specifications we tried. By contrast, in columns 4 and column 5, you can see the first stage in the reduced form of the regression, where even though it's not correlated with those pre-regulation covariates, it is correlated with the amount of mortgage debt you repay and the amount of wealth you accumulate in 2015. And that's where we get that elasticity that's close to 1. We also don't have it here, and I think we don't have it in the paper yet, but you don't see any difference in the house size at purchase pushing around the life event. And we don't see any difference in the change in the value of the house over time. So it doesn't look like differential improvements in the property or differential size of the house is purchased. Again, perhaps related to the fact that these debt to income regulatory constraints don't really move, okay? The other thing we find is a very small change in interest payments under some specifications, where afterwards there's a slightly lower interest payment, about 8 to 13 bips, but it's actually basically offset by the tax savings they lose relative to the other group, because they lose out on some of this mortgage interest deductibility. So there's relatively little other flow difference in that period, okay? These effects also look relatively persistent, okay? So in column 1 of this table, we can rerun this for 2016 instead of 2015. So this is more like 4 years after the regulation, and we still get an elasticity close to 1 and not any different from the elasticity we got in 2015. In column 2, we don't find a statistically significant difference for the subset who resell their house. So it looks like there might be some permanence to this effect from a long run perspective. In column 3, we estimated for 2014, which is sort of the more recent period, that sort of again gives us an estimate close to 1. One of the nice things we can do, though, combining 1 and 3, is those things have very similar elasticities, but actually very different treatment. Because what happens with an amortizing mortgage is the amount of principal you pay over time keeps increasing. So in column 4, what we do is we actually use the delta and delta. So we use the convexity of the change within a household and the amount of mortgage they have to repay over time as our source of variation. So the treatment isn't just a level difference, it's this convexity difference. And again, for using that approach, we find that the delta and delta has an elasticity that isn't different from 1. How do they pay for this delta wealth? Okay. So in column 1, we look at changes in household gross income from 12 to 15. And again, we see, as I said sort of early on, we see an increase in their income from 12 to 15. In column 2, we showed that elasticity is about 0.62. This is gross income. So this means about 36% of the change in wealth could be paid for with after-tax income. Column 3, we throw in a whole host of fixed effects for location and pre-regulation covariates. It doesn't seem to change the elasticity all that much. And in column 4 and column 5, we showed that the effect is driven by an increase in income in 2015, not by differences in income in 2012, right? So it's really coming from that down the road increase in their income to quote unquote pay for this increased wealth accumulation, okay? Anthony mentioned this, and I'll just say it here, we just got access to the hours work data, so we're going to try to bring that in as well to sort of speak more generally to household labor supply as opposed to just these income measures. As I said before, it's not just non-savers. What we show here in columns 1 and 2 is even for households who sort of aren't at their LTV limits, so they put way more money down than they need to, or loan to income limits, we see a similar elasticity. In column 3, we also show a similar elasticity for households who have at least 10,000 euro in financial assets at the end of the year, or they have a relatively high change in liquid assets, enough to fully pay the amortization over that period, okay? Now you might say we've sort of baked that in because they're saving a lot, so obviously they're not gonna offset. Well, we can actually use 2011 financial assets, which in column 4 we show is associated with way more financial assets in 2011, but in column 5 we show is also associated with way more financial assets in 2015. And in column 6, we rerun for that subgroup with more financial assets in 2011, and again, find the elasticity very close to 1. So again, we don't think it's these non-savers. I don't show it here, but we also find very similar elasticities across all age groups, including first-time home buyers who are in their 50s and 60s, okay? So given that it's not savers, what are possible mechanisms? One is a liquidity wedge between these things, right? Illiquid savings and home equity is just not the same as what you have in your checking account, right? As Anthony has shown, part of the problem is that if I lose my job, right, it's now going to be harder for me to actually access that equity via cash out refi. And so exactly in the states of the world where I might want to access that liquidity, I can't, right? And so households being aware of this might say, paying down my mortgage is not the same as having money in my checking account. Maybe they're not even similar at all, right? Now, it's a little bit inconsistent with that, right? We don't have any bunching. If households really hated this thing, you would sort of expect to see some kind of bunching. It also suggests a relatively weird EIS, right? Like the elasticity of intertribal substitution is kind of odd here, right? Like they're willing to massively alter consumption labor supply today and in order to avoid any risk at all sometime in the future of having a reduction in those things, right? So another possibility would be something more behavioral, right? So there's some recent work suggesting that households might act as if mortgages are commitment devices. So in this case, they would have difficulty. They could maybe do short-run precautionary savings without a problem, but they have difficulty wealth accumulating without some sort of mechanism to help them do that. Another behavioral literature that seems related is mental accounting. So there's papers suggesting that households, what's called sort of the mortgage illusion, they confuse mortgage repayments with bills. So they basically treat the bills and the mortgage debt repayment as the same. And then when they conflate those things, they act in a way that maybe would seem atypical from standard models. Or it could be some combination of these things, right? There's been papers suggesting that households maybe act as if they're way more constrained than they actually are. And this is being sort of called the perceived precautionary savings motive. Yeah. Now, if what we're saying is actually true, we would expect to see it in lots of different areas, okay? Not just in the Netherlands, and you would expect to see things that are sort of consistent with this evidence in other settings. And I think we actually do, surprisingly enough, if you really look at the literature, right? So we know that maturity extensions in the US, which reduce mortgage debt repayment, leads to large changes in consumption. Now for that group, it's a group that's very constrained, who's receiving assistance. So it's not clear that's going to really extrapolate to everyone, but our results sort of suggest that that might be a more broad phenomenon than just what that paper is documenting for the very constrained, okay? If we look at the mortgage runoff literature, so these are mortgages that are being fully repaid, and most of that is principal at the end. We see that mostly what happens is muted effects on savings, but larger changes in consumption and income. Now, in those settings, again, this is a weird setting. Households are about to fully pay off their mortgage, And so they sort of act in weird ways as they get close to that. So it's almost certainly confounded by other factors, but it's nice that it's sort of consistent with our evidence. Along those lines, households that choose interest-only mortgages don't seem to save more, but have higher consumption seem to default more. And if you look at retired households, they have high housing wealth, little mortgage debt, and a few non-pension financial assets, which could be consistent with other stories, but is definitely consistent with what we have. Okay. And so in conclusion, we find very little fungibility between these things. Do households undo macroprudential liability? No. So it looks like they're going to have large effects. And home ownership, when financed with a mortgage, is going to have very important implications for wealth accumulation. And I will stop here because I think I'm over. So thank you guys so much.